What we are doing since 2008 is mutualizing the bankruptcy of the system via the debasement of currency, which is the...
When you say mutualizing, you mean making it everybody's problem?
Yes. So economic activity is what pays the interest. If you don't have a job, you can't service your mortgage or your credit card, right? Fact. And if your debt growth keeps going up, you need to keep your wages going up to pay your debts. That's the GDP side of the equation.
RealVision CEO Raoul reveals that since 2008, governments have been avoiding total financial collapse by debasing their currencies. This means they're essentially printing more money to cover growing debts, but it's a short-term fix. The danger lies in the fact that the economy isn't growing fast enough to match the rising debt, so wages aren't keeping up. This imbalance puts the entire system at risk, because without job growth or wage increases, people can't pay their mortgages or credit cards, causing economic stagnation. It's a cycle of deferring the inevitable collapse. Stay until the end of the video to hear Raoul Pal, as he reveals how this problem should not be ignored by everybody. Also guys, only a small percentage of my viewers are actually subscribed. If you enjoy staying up to date with finance content, consider subscribing or liking the video. It's free and you can always change your mind. Now, here's Raoul Pal on the dangers of money printing.
We'll come on to the outcomes in a bit. What we are doing since 2008 is mutualizing the bankruptcy of the system via the debasement of currency, which is the...
When you say mutualizing, you mean making it everybody's problem?
Yes. You can either raise taxes, which they're trying to do too, but they're also printing currency via the mechanism called quantitative easing, which is actually debasing the currency, which means that every time they do it, asset prices optically rise. They don't actually rise. Because if you look at the central bank balance sheet and divide all assets by it, so you're changing the denominator, it's normally US dollars, but when you use the balance sheet, you say, okay, this is the purchasing power of dollars. Now, how many dollars are in the economy or excess printed? And what you find is something like the S&P 500 has gone nowhere. Real estate, gold, gone nowhere. And there's only two assets that have actually outperformed, which were crypto and technology. Okay, which is why we all feel like even though stocks are going up and our 401k is going up, nobody's getting any richer. Okay, we all know this intuitively, that we're not actually getting richer because the stocks I sell doesn't buy me more of a house. So what was the point of buying the stocks if the value of my assets aren't going up? But that is a mutualization, which is bad because it mutualizes it amongst people who don't have assets. So you'll never be able to buy an asset, which is why when you speak to a millennial now, they're like, we can't afford a house. Why? Because they came in to the labor force after the Fed started monetizing or lowering the value of the denominator. So property's got more and more expensive for them. It's impossible for them to buy property really, unless they're really lucky in the workforce or in entrepreneurship or whatever it is. But generally speaking, it's become impossible. And everything has got more and more expensive, assets have, because of this optical illusion. But wages haven't gone up, remember, right? That's the key thing. Assets are going like this. We were doing this before because of demographics, and it was making people pissed. And now we're doing it from debasement, and there's no way around it. So what debasement does, on the other hand, remember, it makes the price of assets look like it's going up. This is why you can't have a banking crisis of the order of magnitude that existed before 2008. The reason being is you just print money the moment you see it, and voila, everything goes up. So the value of your collateral, so if you think about a debt, it's collateral plus the debt, and the collateral is what guarantees the debt. If you've got a banking crisis, your collateral is often falling so fast that, like commercial real estate, right? We're going to have a problem with that. So there's a bunch of debt, and the banks have got this commercial real estate as collateral, and it's all bloody empty, and everybody's going to try and get out of it. So the answer to that is print money and essentially magic that collateral higher, or put it on the central bank balance sheet. Europe has already done this. So I don't think you can have a systemic collapse because the value of the assets can never go down enough. This is what most people can't get their heads around.
Well, so I'm gonna.
But we will get
slightly.
But we'll play out the future a bit, because there are ways where it could go even more wrong than this ongoing mutualization amongst the people of the costs.
It can go even more wrong.
Well, this is wrong because it's insidious. You don't see it, you don't notice it, you just sense it, right? That's what's going on. But it could lead to another outcome. The other outcome could be a total loss of control of the financial system. I don't think that is going to be the case. But there's a possibility. So your future consumption has gone up so much that nobody can afford them. So you've kept them happy with dopamine and sugar hits of crap.
You've kept them numb. I won't say you've kept them happy. You've kept them numb.
Okay, yeah, happy is the wrong word, but you're right. But look, I went down this journey that you're going down now in 2012. And that journey led me to crypto. I saw it and I knew that this was the answer. And that's why I first bought Bitcoin in 2013, was exactly this, is once you see what has happened, we know the system now, regardless of how it ends, whether it ends in slow, ongoing death of economic vibrancy or a spectacular blow up, the answer is you need to transition to what I call the Bitcoin life raft or the parallel financial system. It's there, and you can participate with $1 or $1 billion. This is the bit we talked about, right? So the economy grows at 2%. The government needs that to pay its interest because it's 2%.
How does it use that to pay its interest?
Well, basically it comes
because they're just taking more in taxes?
Exactly, right? There's a level of economic growth that needs to service the interest payments. But if everybody's interest payments are too high, the answer is firstly to have the interest rate as low as possible, which is why the Japanese have a much lower natural rate of interest than everybody else, because they're 260% of GDP in debt. But their companies are less in debt.
So they've trapped themselves. They have so much debt they can't let the interest rate rise.
Nobody can. This is why we're going to have a recession and we're going to cut rates back down to zero. It's impossible to work. So this is the thing, is once all of these governments hit 100%, then you either blow up the private sector, the banking sector, corporates, or the government sector. You choose.
How?
Because there's not enough income to service that level of debt, because GDP growth keeps declining.
Okay, so let me see if I understand this. So when you say private sector, you mean private banking?
No, I mean all private sector, households. So how does the average person service the interest? It's again from economic activity, the activity that they have. So the same with corporations, and the banking system is involved intricately within that whole system. So economic activity is what pays the interest. If you don't have a job, you can't service your mortgage or your credit card, right? Fact. And if your debt growth keeps going up, you need to keep your wages going up to pay your debts. That's the GDP side of the equation. But what we're finding is that all debt that is in excess of GDP at government level is ending up on the balance sheet 3.5 years later.
Okay, how?
Quantitative easing. And I did the maths on this, and I think I was the first person to really I don't think anybody's really figured this out yet. I went and looked at this, and I realized that what they were monetizing was the interest payments on the debt 3.5 years later. Okay, why 3.5 years? In 2008, all interest rates went to zero. Every government refinanced itself at zero. And most of the debt for all governments is in the 3 to 5 year sector. So somewhere between 3 to 5 years, 3.5, 4 years. And what happens is every time you service the debt, you need to get the interest rates back down again. You end up having a recession. You get this very cyclical phenomena.
Because are they deferring the need to pay for 3 to 5 years?
Nobody pays back debt. No, nobody. Nobody is paying back any debt anywhere. So what they're doing is every time it comes to pay to service the next amount of debt, it ends up on the Fed balance sheet. Now, it actually happens because there's an economic slowdown driven by the debt, but that's what happens. And there is a marginal difference in the size. This is true of the US, the UK, the EU, Japan. They're all the same. And the difference of the balance sheets is slightly bigger. And the difference is every time there's a direct financial crisis, they have to put direct money in. So we've already just seen a little bit of that in the US. Stimmy checks, that's coming in onto the bank balance sheet because that is government debt that will end up getting monetized 3.5 years later, which happens to be end of this year into next year, which is why I think we've got a lot of quantitative easing coming, because we've got to monetize all of the bloody interest payments from the pandemic.
And when we say monetize, we mean print money.
Print money and put it on the Fed balance sheet, i.e. just print money. Expand the balance sheet of the Federal Reserve.
To match what is owed, we will create money.
Correct. And that's using a credit card to pay off your other credit card, essentially, right? Printing
now, is that
money,
what you mean by nobody is servicing debt? Is just everybody's printing more money?
Correct.
Because surely they are actually paying the debt
payments. No debt is getting paid off. You're just rolling the interest payment. So it keeps getting bigger every year.
Hold on.
So debt is growing in all of these countries at GDP plus the interest payments. And that interest payment component is going on the balance sheet. And that's happening everywhere, including Japan. So they're all doing exactly the same thing, which is interesting. Because that doesn't happen by accident. There is an understanding that the world is too much in debt and there's no way of dealing this without us all going back into caveman times. So this is the answer. But this is where the fourth turning comes to me, right? I think we are at economic warfare. Everybody needs an enemy. So we've decided that China, Russia, whoever we want to be our enemy is our enemy. So we are economic warfare for the share of the pie. But the world it's not actually a fixed pie. There's an abundance. And that abundance is the other economic warfare, which is technology. But that's happening at a massive scale. And it's going into space, it's going everywhere. So we've got physical kind of warfare, economic warfare over technology, which is what Taiwan is all about. You know, they own the secret code, which is the ability to produce computer chips in ways that nobody else can replicate. So there's that. And then we are at war with each other as the population is split and wants to blame each other for what has happened, when in fact it was actually the baby boomers that actually caused the problem in the first place. The people caused the problems of the people. It doesn't. It actually reflects today. So you could basically, as I explained before, the thing that's actually driving the S&P 500 is the Fed balance sheet. It's not companies getting more valuable.
When you say driving, you mean driving the price.
Correct. So it's an optical illusion. It's a money illusion.
So the price simply rises to meet the level of inflation caused by printing money.
Correct. You're readjusting the price. So that is what's going on. And so then when you understand that, and it's 97%, you understand that nothing matters apart from this liquidity, which is what I've been trying to tell people, is sorry, all your economic models are wrong. Yes, you need to forecast the business cycle to know where you are in the probability of printing money cycle, but that's all that matters, and it drives assets. And that's why people right now are getting very angry because the stock market's going up, and they're like, yeah, but don't you know there's a recession? Yeah, I know that the answer to recession is more cowbell, printing of more money.
Raoul Pal strongly believes that this money printing stops the financial system from collapsing. But it's dangerous because it creates a fake sense of security. Every time the value of debt looks like it's getting out of control, they just print more money to keep things from falling apart. However, this could lead to an even bigger crisis down the road. If the system loses control, it could cause a major financial disaster. much worse than what we're seeing now. The problem is creeping up slowly, and most people don't realize how bad it could get. Anyway guys, before we go, if you want to stay most up to date on the crypto and Bitcoin world, make sure to subscribe to my daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top on-chain analysis, trusted by over 50,000 subscribers for insightful crypto investment information. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. I hope you all enjoyed today's video and that it provided you with some value. I'll see you all in the next one, and as always, all the best.